Hello, I'm Barbara Egan,
And I'm Esther Hubler.
and we're from Abco Federal Credit Union. Recently, we held 2 live virtual sessions on understanding loans and credit, and we thought we'd create a brief recorded version just to share the information for our members. So, what is credit? Basically, credit is the ability for a person to obtain goods or services before making a payment based on that trust that the payment will be made. Credit can be secured or unsecured. Most people are familiar with, you purchase a home or you purchase a car. Those are definitely secured loans. And you can also secure loans based on your savings. So what that means is with a secured loan is the property and or savings is called collateral. And what that means is if the loan is not paid, the lender has the right to take ownership of that property. So if the collateral is a savings account, the monies could be on hold until the loan is paid off or could be released as the loan is paid down. And that's pretty much how that secured loan works. An unsecured loan would be personal loan, credit cards, could be store cards, basically any type of unsecured loan where you're basically getting credit based on your signature. This is Esther's ballpark. How does the lender make a credit decision on a loan?
So there are a number of different factors that we consider in lending when we're underwriting a loan request to make a decision. So we obviously are going to look at the amount that the request is being submitted for and how long the repayment of the loan is. We look also at the type of loan. Is it secured? Is there collateral? Do we have something to fall back on in the case of non-payment? Or is it unsecured, which tends to carry a bit higher risk? We look at the ability to repay, and that basically tells us how well a borrower qualifies to take on this new monthly payment. We always want to work toward approving a loan and at the same time balance that with the knowledge that we don't want to put a member in a financially difficult situation. And often the ability to repay or the debt to income ratio will tell us how well a borrower can actually afford that new payment. We look at how long a member has been employed. We look at how long a member has been in the same line of work. Sometimes we may find that there may be new employer, but it's the same line of work. So we take that into consideration as well. Credit history plays a big part in the decision. Past performance often is a good indicator of future performance. And so we are looking at any existing trade lines, any old trade lines to see how was the payment pattern on each of those. Were things maxed out? Was anything late? Is there anything delinquent right now? Or is everything paid in a timely manner? And then finally, credit score itself does play into determining what an interest rate will be on an approved loan. So we have different tiers of credit associated with different tiers of risk. So the lower the credit score, generally speaking, the higher the interest rate to compensate for what is considered to be a bit more risky.
If you're not familiar with your credit history or your credit score, those can all be found on your credit report. Depending on the type of accounts that you may have, you might have access to a credit report. But basically that credit report shows a history of information about you. So definitely your name, address, social, date of birth, your employment information. It's also going to show what existing credit you have. So whether you have none, whether you have a lot, it lists what you have, the credit terms and the payment history. It will also show any court judgments, liens, or property or bankruptcy filings, and obviously those are not good. And then any companies or persons who've recently requested a copy of your report. So the credit score is basically a number that's assigned based on your payback behaviors, the capacity you have on your cards, and any judgments or bankruptcies, which I just said. The score is also not affected by your name, address, or job history. When we talk about national credit bureaus, there are 3: Equifax, Experian, and TransUnion. Basically, one thing to know is that not all lenders use the same criteria for obtaining credit information. If a lender reports to all three credit bureaus, then your score would be the average of the three. If a lender was only reporting to one or two, that decision would be based strictly on that bureau's reporting. And for whatever reason, they're not necessarily all identical because not all financial institutions, again, report identical information. But the differences in how a financial institution pulls credit could be the difference why maybe at one institution you were easily approved for a loan and another one it might have been more challenging. A lot of people also seem to feel that it's easier to get, especially an auto loan from a car dealer. And one of those reasons, especially if you chose your financing through GMAC or Ford Credit, would be if there's an element of risk and the car needs to be repossessed, they're a car dealer. So they're in the process of selling cars. That's their business. So they're probably would be willing to accept a little more risk than maybe somebody who is not. All of this information about your credit can be found on your credit report. So there's a number of ways to obtain this. This is a snapshot of ID Protect, which is one of the benefits of ABCO's Protection Plus checking. I have that as a benefit. And I also, every 90 days, I can pull a full credit report, which is 90 plus pages. It really is in depth. And it is good to look at your credit report from time to time. Other products that can provide this information would be LifeLock. You pay a monthly fee, to be alerted when somebody pulls your credit. You can actually go to Experian, for example, and set up a free Experian account. A lot of times people are encouraged to set up a free account and lock their credit, especially when there's been a breach, which seems to happen from time to time. Yeah, I actually just recently locked down all of my cards. So I don't really have a TransUnion account, but you don't need an account with TransUnion to be able to sign on and freeze your credit. Like all the bureaus allow you to do that. Of course, when you freeze your credit, you have to remember if you apply for a loan, you have to unfreeze it because the lender's going to go pull it and they're not going to be able to get information. So that's, you just have to be mindful of that. If you don't have access to any of those means, what you also can do is visit annualcreditreport.com and you can pull one credit report for free for each trade per year. So if you don't have any means, then I would suggest you pull one from TransUnion and then the next quarter one from Experian and then the next quarter one from Equifax. And that way you can kind of just keep up on what your scores look like. Now, what do you think about Credit Karma? A lot of people tend to use Credit Karma.
Well, it's fine for general knowledge. I think that often they will provide a credit score to a consumer that is just that. It's a consumer score, which is very different from a lender's credit score. So sometimes we've found that members will have that Credit Karma score in their mind when they apply for a loan, and then it's a different score when we get it through our model. So that's just something to keep in mind. It's okay to use it to track activity and to see where your balances stand, to make sure that nothing is going on with your credit that shouldn't be going on. And so all of that is, great for something like that. Just understand that credit scores can vary pretty significantly from one model to another.
Right, good, makes sense. So we talked about credit score and what makes a good credit score. Well, credit score, also referred to as FICO score, generally 670 is considered good credit. You can kind of see how it's broken up. Esther, what is, for the different loans, what is the minimum score that we generally look for?
So we are going to be looking for a score of at least 550 or higher to be considered. That does not mean that it's an automatic approval. It just means that anything below that is outside of our policy. And the higher the scores, the better the interest rates.
Absolutely. Okay, good. So what makes up your credit score? You can see there are several pieces of the pie. The most important and the largest percentage is your payment history. So really the most important thing you can do is pay your bills on time. That can't really stress that enough. The second biggest piece has to do with how much you owe. So whether you have one card or you have, loans, mortgages, and several credit cards, the amount of credit that you're allowed to use versus how much of it you've used makes a big difference. And I'll explain that on the next slide. That's called credit utilization. So then you have the length of credit history. Are you a very fairly new borrower? Do you have a long history? I know when I pull my credit report, I have the very first credit card, which I don't remember which one it was. I have credit cards that I haven't had in my wallet for decades, but sitting in a loan class once and saying, oh, should I close out all these old accounts that I don't use? And the presenter was like, no, don't do that. And that's one of the reasons why, because if nothing else, even if I don't use the card, it does create a history for me. So then you've got, new inquiries, new accounts. So again, that's 10%, not a huge piece, but that's also why if you're looking to apply for a mortgage soon, people will say, don't open new cards, don't close any cards, just kind of keep everything status quo. It just looks better on the credit report. And then the types of credit is also 10%. So the credit utilization, basically you've got the balances that you hold on a card and the limits. So if you were to max them out, and then there's a credit utilization ratio that's assigned. So in this example, there's one card which is not being used at all. So that's a 0. Card 2 is really, 80% use, of that card. The third one, 14. So it averages out to a 41% credit utilization ratio. And again, that's 30% of that score. Some people recommend keeping that credit utilization rate no higher than 30%, but really the recommendation is between 1 and 10%, because that really will have a huge impact. And if you can keep that credit utilization rate low and pretty much do everything else, pay bills on time, that's really going to help your score. So why do you need good credit? Well, there's a lot of advantages to having good credit. So it definitely makes you look more favorable with your interest rates on a loan. Most of the time, and especially, at ABCO, we always promote our as low as rates, but there are other tables. So, it goes higher depending on the type of loan and again, the credit score and the term of the loan. So that's one reason. If you're looking for employment, many industries look at your credit, especially if you're in a financial industry, police department, et cetera. But more and more that it kind of becomes a judgment of your character. Insurance companies will look at it and that will affect the rates that you're given. And even when you're applying for, for a rental property, they're going to pull your credit. Again, it shows your behaviors. Do you pay bills on time? Do you pay back? Are you considered a risk? So, ultimately, having good credit can save you money.
Absolutely.
So steps for building or improving your credit score, again, can't stress this enough. Pay all your bills on time. Keep your credit utilization ratio, again, less than 30%, 0 to 10 is even better. Really, don't max out those cards. Try to cut yourself back and catch yourself before you get too far, into debt. Don't close out old accounts. Never close out your first card. And you shouldn't try to open a flurry of new accounts at the same time. Another tip, if you are someone who has good credit and you have a good credit score, and maybe you're trying to help your young adult child or partner improve their score or establish credit, you can add them as an authorized signer on your card. That alone won't stand, but it will help them develop. And then if they get, a low balance credit card that they can kind of work with in conjunction, that's a kind of a good way to get people to either improve or create or establish credit. Anything else perhaps that we haven't talked about?
I think we hit the large topics.
Okay.
For sure.
So if you are thinking about a loan and you want to perhaps have a conversation with somebody about it, you can reach out to loans@abcofcu.org or reach out to business development at apcofcu.org with any other product-related questions.